The gold-silver ratio shows how many ounces of silver are required to buy 1 ounce of gold. For centuries, it has been one of the strongest relative value indicators used by investors. This ratio answers the question of which one is expensive and which one is cheap. But its real power lies in showing when a position change should be made. In other words, the issue is not whether you like gold or silver, but which one is more advantageous in a given period. As of now, the gold-silver ratio has fallen to 54. When we look at history, we see that the long-term average of this ratio is around 60. In ancient times, especially during the Roman era, the ratio was in the range of 12 to 15. The reason for this was that states fixed gold and silver within an official monetary system. In the modern era, however, free market conditions, industrial demand, and monetary policies have continuously disrupted this balance. Throughout the 20th century, the ratio fluctuated mostly between 40 and 80. During crisis periods, however, this balance changed dramatically. For example, during the silver speculation of 1980, the ratio fell to 15, meaning silver became extremely expensive relative to gold. In contrast, during major crises such as 1991, 2008, and especially 2020, the ratio rose above 100, showing that silver was extremely cheap compared to gold. During the pandemic panic of 2020, the ratio approached 120 levels, which is a historically very rare extreme. So what do these ratios mean for investors? First, let's be clear. The gold-silver ratio is not a buy-sell signal, but a signal for switching between assets. The goal is not to time the market, but to move from the relatively expensive asset to the relatively cheap one. The generally accepted strategy is this. When the ratio rises above 80, silver enters a historically cheap zone. These levels represent advantageous periods for switching from gold to silver. When the ratio reaches the 90 to 100 range, silver is considered heavily suppressed, creating a strong opportunity area for long-term investors. In such periods, buying silver is essentially like buying gold at a discount. Looking at the opposite side, when the ratio begins to fall below 50, the balance changes. The 45 to 40 range indicates that silver has become expensive relative to gold. Historically, these levels are areas where switching from silver to gold makes sense. If the ratio falls to the 30 to 25 range, which is very rare, silver is considered extremely overvalued. These points usually signal the end of silver rallies. A critical mistake should be avoided here. Silver should not be sold immediately just because the ratio is falling. What truly matters is whether the ratio has reached extreme zones. Within a trend, the ratio can remain high or low for months or even years. For this reason, the gold-silver ratio is not a short-term trading tool, but a cyclical asset rotation tool. At this point, it is necessary to talk about a gradual selling and transition strategy. When the gold-silver ratio reaches the 50 level, it is generally accepted that silver has entered a zone where it is becoming historically expensive. Selling approximately 30% of the silver in the portfolio and switching to gold can be a balanced first step. When the ratio declines to the 30 level, silver approaches an extreme overvaluation zone. At this point, selling an additional 20% and converting it to gold becomes a reasonable move to reduce risk. If the ratio falls to extreme levels such as 15, which are historically very rare, this usually points to speculative peaks in silver. Selling the remaining 50% of the position and fully switching to gold becomes a rational strategy. However, it must be remembered that every investor's risk perception, time horizon, and portfolio structure are different. Therefore, these gradual selling ratios should not be seen as strict rules, but as a framework that everyone should adjust according to their own risk tolerance. In summary, when the ratio rises sharply, patient investors switch to silver. When the ratio falls excessively, disciplined investors sell silver and return to gold. This approach allows you to accumulate more ounces over the long term by using historical balance, rather than making price forecasts. An investor who reads the gold-silver ratio correctly does not try to beat the market. Instead, they benefit from cycles.